A series of gap downs sustain a steep, long-term downtrend. From April to May, there was a potential double bottom, then a less strict triple bottom that developed into a resting phase as part of a characteristic bearish continuation. However, the drop was not sustained to see single-digit prices, as volume was bearish but declined significantly after the bullish spike on May 22nd. Now there will be plenty of attention to see if resistance will repel the early uptrend due to the nearing intersection of the 1175 resistance level with the stable long-term downtrend line. As seen with other examples, there is strong resistance even though bullish sentiment remains, especially with the large green spikes at the end of June. Also, selling volume remained at consistently low levels until late July. As with other examples, a trend line won't always pinpoint an exact downswing down to the day. Like in this case, there was still a bearish reversal in the approximate area of trend line and resistance level intersection. No contact with the downtrend line is due in part to this downtrend line covering such a long time range. As seen before, even clear trend lines can lose precision over longer time ranges before and after being crossed. Now most market attention waits to see whether support mainly defined by rounded off price levels around the lower wick of the May 22nd candle will hold. As noted before, there is stronger resistance potential from the intersection of a resistance level and a downtrend line. Here it is 11 with the long-term downtrend line. However, it is not a guarantee price will definitely reverse, especially with a clear bullish advantage into August, with steady bullish volume remaining above normal levels while candles close consecutively higher. Just before the gap up, there was normal roll reversal with the upper boundary of a recently completed double bottom supporting a downswing, along with the old long-term downtrend line. The shorter-term events are more relevant and precise compared to the 11 level, which still has major long-term influence, but is less precise in identifying roll reversal from early to mid-August. Here is a case of a major reversal from a less strict triple bottom that combines the recent double bottom with the sharp May 22nd, 2014 upswing. Since May 22nd was a large green candle, there was no closing price visible in the 1035 to 1020 boundary that often occurs with triple bottoms. Nonetheless, price action is still neatly contained within a bullish reversal range for a neater pattern that displays clear stability in the long term. A new gap level, 16, and an old gap level, 1691, offer natural resistance to the triple bottom's uptrend. In March 2016, a very compact but strict head and shoulders forms to produce a swift reversal to a more short-term bullish incline from February. This is a near perfect head and shoulders, but one that would have been difficult to spot for most due to being so compact. The neckline was especially influential due to being near the closing price of an earlier gap up, and the round price of 16. After a major drop from the 16 level that offered sustained resistance, AEO has developed a shallow incline within a clear range defined by the triple bottom in 2014. These levels could be adjusted to more closely approximate the open, low, high, and/or close price of the gap down candle in mid-May. However, this is not entirely necessary as swing points in the following weeks are mostly contained between these round price ranges that are still close to the real body and wicks of the large gap down candle. Here was an instance of an uptrend being delayed due to major volatility in late August. This also leads to a failed ascending triangle that would have broken over 1230 to progress the upswing from late May. However, a large bullish reversal did occur from a declined double bottom extending to a wide triple bottom. This would have been difficult to spot in late August because of high volatility and bearish volume spikes that appeared to be forming a large bearish continuation. That is more common after a failed ascending triangle. This case demonstrates the impact of major volatility in reducing the effectiveness of chart pattern analysis. It also highlights a less common scenario where a bullish continuation pattern, in this case the ascending triangle, fails, but the chart still remains bullish due to a large bullish reversal. In this case, the declined double bottom extending to a wider triple bottom. This naturally made it difficult to analyze developments, particularly in late 2017. It is certainly one of those cases where analysis can still be effective, but for most it would be after the price action had unfolded to reveal the wider triple bottom. This would direct attention to the long-term roll reversal of the 1230 area, as price began trading higher in late 2017, just above major long-term lows. Just like before, the old gap levels at 1997 and 1691 retain influence. The price levels are directly taken from close and open prices of the candle forming the first gap presented in this case study. They are the site of repeated roll reversal. There is also lowered accuracy of these and other price levels and ranges as volatile price action periodically takes place.